Hello everybody, welcome to my video. So today in this video, I'll be discussing what is a transfer pricing policy and why is it very important for a multinational to maintain a transfer pricing policy document. So let us first just touch upon what is transfer pricing. So as most of you are aware of the concept of transfer pricing, it has been established by way of Article 9 of the OECD Model Tax Convention. Essentially, transfer pricing refers to the concept of avoiding shifting of profits from a higher tax jurisdiction to a lower tax jurisdiction within the same multinational group. So just to give you a practical example, what happens is within a multinational group, suppose a group has sister concerns or subsidiaries in 2 or 3 different countries, and these different countries will be having different corporate tax rates to which the subsidiaries will be subject. Now, there will also be certain intercompany or cross-border transactions between these group entities, and there will be some of these transactions which are on revenue account will be tax deductible expenses in a particular jurisdiction. So a group tries to structure its transaction in a manner to park its profits in a low tax jurisdiction in order to minimize the effective tax rate for the multinational group as a whole. So the whole concept of transfer pricing is based on this premise to avoid a multinational company from shifting its profits to a lower tax jurisdiction. And each and every country should get its fair share of taxes. And therefore, this whole concept of arm's length principle and transfer pricing has been incorporated within the domain of income tax laws of different countries. The concept of arm's length principle, essentially it means that suppose there are two entities, two related entities or associated enterprises which are dealing with each other, which have some international transactions between them. So this particular transaction, the international transaction between an associated enterprise, must be at that arm's length principle, which means that there will be certain similar transactions which unrelated entities or independent enterprises must be entering into in the market. So the related entities should enter into the international transaction on same or similar terms, same or similar pricing as an independent entity would undertake that particular transaction within the same economic conditions or market conditions. Let me give you an example. So essentially, say there are two related entities, say A and B Limited. A is in country A, B is in country B. Now A is selling 1 kg of apple to B Limited. A is selling this 1 kg of apple to B Limited at say rupees 100 or US dollar 100 per kg. Now there are two unrelated entities, independent entities within the same jurisdictions within country A and country B, and this entity in country A, say X, which is an independent entity, is selling to an entity Y in country B apples at say 200 rupees or 200 US dollars per kg. So 200 US dollar becomes an arm's length price for the international transaction, which is being undertaken at 100 US dollar for the tested transaction under the question. Now, this is the whole concept of transfer pricing. I have even made a video on the concept of the arm's length principle separately. You may refer to it for more detail. Now, let us come to the concept of what is a transfer pricing policy. So, essentially, a transfer pricing policy document, what it does is it analyzes the transfer pricing arrangements such as the risks, the functional analysis, the prices, and the terms and conditions of a particular international transaction. It documents it properly. It also benchmarks or determines in advance whether that particular transaction is meeting the arm's length principle or not. So what a transfer pricing policy document does is it will first identify what are the international transactions. It will undertake a functional analysis, a functional asset and risk analysis for that particular transaction. It will also conduct a benchmarking analysis to see what independent enterprises in the market are actually charging for a similar transaction which is being undertaken between unrelated entities in similar market conditions. So essentially, a transfer pricing policy document will give you a benchmark rate at which by you, I mean the multinational group, should be undertaking that international transaction. It will give you a benchmark rate or a benchmark margin at which you should be dealing into when you are entering into international transaction. So, why a transfer pricing policy document? A question may arise. Suppose you are planning to enter into a new international transaction. It will help you to assess what are the market rates that are prevalent. It will help you to decide what rate you should fix for that particular international transaction. Second can be, suppose there is a jurisdiction such as UAE, which has recently implemented a corporate tax regime or transfer pricing regime. So having a transfer pricing policy in place will help you to assess whether your transactions, which you are already undertaking with your related enterprises, whether they are at an arm's length or not, and whether there is any transfer pricing risk in future, which you can mitigate or you can take any action to mitigate that risk as on date. Now, this slide, it lists certain components of a transfer pricing policy. So a typical transfer pricing policy will consist of a functional analysis. It will consist of the summary of the international transactions. It will consist of the benchmarking analysis for each and every international transaction. Then there will be certain key action points. There will be an implementation strategy. So it will again depend for what purposes are you undertaking a transfer pricing policy documentation. So for example, in case of a UAE entity where the transfer pricing regime has just come into place, and usually the multinationals, so in my experience, I have seen that a lot of multinationals have prepared transfer pricing policy documents to understand whether their international transactions or their related party transactions are at an arm's length or not. So in that particular case, it will become important to highlight the key action points. Essentially, what it means is what they can do to bring their existing prices of the related party transactions at an arm's length, and an implementation strategy for that is also included with the proper suggestions. So essentially what a transfer pricing policy does is it helps to harmonize the tax compliance with business goals and reduces future adverse transfer pricing audit risks. That's it on the transfer pricing policy documentation. If you have any further queries or if you want to get in touch with me to understand whether preparing a transfer pricing policy is required for your particular business, your multinational or industry, then do get in touch with me on the given email ID. Thank you so much for watching. See you soon. Bye bye.